Well, hello and welcome to our quarterly economic review webcast with Jerry Boyer. We're so delighted you took the time today to join us wherever you're logging in from, whether you find yourself in an office environment or whether you're at home. We're glad to have you here. I know we've been looking forward to spending this time with you. I know Jerry has been preparing and has a lot to share with you today. And we're going to give him plenty of time to share his prepared remarks before we turn it open to you to ask your questions today. This is a time each quarter where we have the opportunity to look back and reflect on what has taken place in the markets and the economy, and also look forward. And Jerry will offer his analysis of both, but always through a biblical lens. And that's what we appreciate about Jerry Boyer, our friend and fellow faculty member, if you will, here at Kingdom Advisors. He brings a depth of biblical knowledge and training and understanding and combines that with his extensive experience and expertise in economics and markets and analysis. Jerry's the chief economist at Vidant Financial. He's the editor of Town Hall Finance. He's the president of Boyer Research. He does find himself periodically on some major news outlets, speaking on the markets and the economy, writing often. And I know he's become a good friend and fellow peer to many of you on the line today. Jerry's a frequent contributor at our events, and we're so grateful that he serves in this role, providing this quarterly commentary to us. There is a way you can participate with us today. We'd love to collect your questions during Jerry's prepared remarks, which will go on about 40 minutes. Jerry has a lot of ground to cover today, but I'll be receiving those questions. Just beneath the video window today is a question submission box. And so if you'll put your question in there, hit submit, I'll be receiving those. I'll take as many as I can get, and we will get to as many of them as we can in what will be about a 20-minute Q&A portion of today's presentation. So be sure to submit those. If you have any issues with technology or any challenges, feel free to submit it in the box, or just navigate over to the on the bottom right of the screen, the chat box, and our team will be standing by ready to serve you if anything comes up along the way. So with that, let me welcome Jerry Boyer to the webcast today. Jerry, my friend, good afternoon.
You're rocking there.
All right. Well, I wasn't hearing you there at the beginning, but I think we've got you now. So let me welcome you again. Hello.
Thank you. It's good to be here. 40 minutes. I love your optimism.
Well, in the rehearsal, it was an hour 5, but I'm just assuming you were able to tighten it up ever so slightly.
2 slides.
Well, I'm excited to hear what you have to share. I'm going to get out of the way, Jerry, and turn the floor over to you.
All right. Thanks, Rob. Yeah, we're just going to kind of roll through this. So we're going to start off sharing our screen. And this is a map of planet Earth where we live, with the different countries delineated with their barriers. He has set the borders of their habitations, as Paul tells us in Acts 17. And we've color-coded them according to the return in a broad index of the stock market of each country, green being positive, red being negative, yellow being 0. This is a 1-week rolling return. So like each one of them is going to be a day, but each day is basically going to be telling you what is the trailing return from a week ago. So that's not cumulative. It doesn't take us through to the end of the period. So by doing that, by doing 1 week at a time, it enables us to see turning points more easily than a cumulative map, and it avoids some of the volatility of a daily map. So let's start the world rolling. It starts off kind of greenish in the beginning of the year. And what we see is that we have a little delay here starting. Sorry about that. Or a glitch, one or the other. But we started off January 1st, the 1-week rolling return. That's okay. Just keep working on it. See what we can figure out. The 1-week rolling return is basically the last week of 2019. And we're having a little glitch here with our data. This happens sometimes, we find, with animated videos when we pull them into PowerPoint. So apologies for that. And now we're going, and we're off to the races. And January is a green, year, a green month, and we're getting into February. Oh, there's some problems, and we get into March, and March is a tough month. And look at that, boom, starts with China, hits all the commodity countries, and the world's turning orange and red around then. And then even at the end of March, there's a bouncing back. And now what we see is a sort of back and forth between very positive and negative or low returns as the world is trying to figure out what's going on. And different countries are responding differently. And it's basically a fog of confusion. It's, there's something in James: a double-minded man is unstable in all his ways. And we're a double-minded world with a double-minded media. And so we've got this on again, off again thing going on. Basically, in the third week of March, the whole world goes into a panic mode, and then it comes out, but then panics again a little bit there. And then kind of comes back with some more confidence as we're trying to understand the pandemic, trying to understand how bad it is or isn't, sorting through conspiracy theories about it, trying to see whether the economic shutdowns are the right response or whether you ought to embrace herd immunity or something like that. And so what we saw is that was green almost the whole year, which means that the losses were highly concentrated in short periods of time. And I think that's important to understand. Now, let's go on to the next map. This one's cumulative. So by the time we've finished running this one, you can start now. By the time we finish running this one, it will be year to date. And we see starting off very green January, good, especially for emerging markets. February, we're starting to hear about the crisis. See, there's something going on in the markets. And in March, there's a real fear with commodity countries, and there's an Asian fear, some stuff going on in China. And in April, we're trying to fight our way back out of it. But we see these are positive, but we still haven't fought back enough to undo what happened in March. And then, by June, look at China. Isn't that interesting? It was ground zero, and yet it was a good returner year to date. And so what we see is some of the world, let's go on to the next slide. Some of the world had made back what it lost. Almost all the lost was in March, some in April, but not all of the world. The U.S. has just barely made back what it lost. Some other countries made back significantly more than they lost, especially in Asia, interestingly enough, since that was essentially ground zero for the pandemic. Okay, don't worry, these slides aren't going to move. They're static color. On the left, you have total return, but this is just the second quarter, not year to date. So Jerry, this is a second quarter review. Why did you do all that stuff from the first quarter? Because frankly, we're still wrestling with the first quarter. We still haven't really gotten, we've not done enough analysis and gotten a sense of what happened there. It was so new when I was talking to you 3 months ago that I think it bears going back and doing analysis that we've seen. So this is the second quarter. So this is the bounce back quarter. So on the left, you see the returns, same scale. Green is positive, and red is negative, and yellow is zero, and greener is more positive. Like Australia, pretty nice quarter for Australia. Australia, New Zealand, Belgium, very good performers, the best performers during that quarter. That every country was up in the second quarter, and every country was down in the first quarter. Isn't that interesting? Okay, so I'll just tell you, I won't show you the poor performance in the first quarter. The poor performance in the first quarter was due to contraction of valuations. We didn't have changes in earnings. We had changes in price without much change in earnings. So essentially what was happening is PEs were shrinking. We were crushing valuation. Now what we see here over on the right, we see the opposite effect. We see it going up in valuation, becoming less attractively valued. Let's put it on a scatter chart so we can see the relationship better. Total returns on the Y. So that's the data from upper left and then upper right. And what we see is a negative correlation between returns and the attractiveness of valuation change. The world was marked up. It became more attractively valued by far during Q1 and became less attractively valued by far during Q2. It's like we squeezed a sponge and then we let go of the sponge. That's fascinating. This is almost all a valuation thing going on. By the way, in terms of causative factors, the best overall factor explains differences in returns is expectations for growth rates in the future, growth forecasts. Other than that, each country's story tends to be its own country's story. You get really bad first quarter COVID infections in Brazil, and then you get the bounce back. You have, maybe some people would argue maybe better handling or less trouble in New Zealand, and then that kind of comes through the time better. So you have all this specific to the country. How bad was the disease? How quickly did they get to the flattening of the curve? Are they on the one side or the other of it? All that discussion, all that analysis. I'm not an expert on pandemics. All I'm saying is that markets are responding largely in individual countries to their individual handling of this crisis. Crisis, by the way, in Greek means judgment. When Jesus mentions the word judgment in the Gospels, he's actually using the word crisis. Crises evaluate us. And then markets evaluate that. So anyway, so we see that we have largely an expansion of valuation undoing a contraction of valuation. We have largely a bounce back in the second quarter. Markets panicked. Let's go to the next one. And as I mentioned, markets tend to overreact. Jumping off at moment of maximum panic is usually not the wise course of action, although it is overly common. Again, double-minded man. When instead of weighing risks like Solomon, weighing things, Banah, instead we tend to be all one thing or all the other, all one emotion or all the opposite emotion. Okay, what did we learn about catastrophic losses during the crisis? I don't know if you remember last year, I showed you what we called lab notes. Rob said, "Hey, Jerry, what are you working on?" And I said, well, we're working on something that identifies countries that are at high risk for a catastrophic loss when a storm comes along. Share that with us. So I shared it with you. Now, at that time, we didn't have this crisis in the data set. We were doing this work a year and a half ago or a year ago. This crisis hadn't occurred. So this crisis is a test of that model. We now have had another crisis since we created a model that shows countries' tendencies to respond poorly during a crisis. So let's look at what we've learned. We're always learning. So the analogy we get, it's not original with me, it's from the Sermon on the Mount, is that you've got a house. It can be built on stone, or it can be built on sand. Graphically, we've just done cracks in the stone rather than sand, but it's the same basic idea. There are structural weaknesses in the house of an America or a Japan or a China or a Russia or whoever. There are structural weaknesses. And we tried to identify those structural weaknesses, and they make them vulnerable to collapse. We identified 5. There are more, but these are 5 we've done a lot of rigorous work on. A leadership crisis. Leadership goes in the wrong direction. A real estate crisis. A bank crisis, which a real estate crisis is a kind of bank crisis. A foreign currency crisis, and a bubble popping, a crisis like that. And there are different kinds of cracks in the foundation. There's a different path to each of these. It's not just you're on sand or you're not, but there's different kinds of susceptibilities that cluster together. And these things show up during storms. Just like our master said, when the storm comes, that's when you get the flood, and that's when things get washed away. But while we don't have a storm, there you have the sun. Nothing was happening. But then the storm comes and crash. Great is the crash of the house. So these things tend to kick in when you have certain storm environments. We looked at storm environments that were common. We found the common in the data. A strong dollar. especially with currency crises, an oil shock regime, oil prices going down a lot, and weak copper, a copper shock. These things, oil shock tends to be a sign of geopolitical stress or growth stress. Copper tends to be growth stress, and strong dollar can be any kind of stress. When the world is afraid, it's risk off, and they go to the dollar, which is the reserve currency of the world, at least for now. Okay, let's move on. Did we have a copper shock? Oh, yeah, you see that over there on the right. That looks like a copper shock to me. And then we had a copper bounce back. And remember what I said, markets get the direction right, but they tend to overreact. Did we get an oil shock? Oh, yeah. We got some oil shock. Wow. By some measures, using 90-day futures, we actually got negative oil prices. I think we talked about this 3 months ago, which I told you I thought was an overreaction. Again, direction was right. The economy was slowing down. But again, there's this thing with the crowd mindset, is there's wisdom in the crowd, but there's also a crowd mindset where it reinforces itself. And I panic because you're panicked, and you panic because someone else panicked, and it spreads. So markets have wisdom in them, but they also have emotion in them. And of course, just like with copper, we saw a bounce back. We saw that come back. Okay, so markets did kind of overreact. All right, this is a lot of detail, so I'm going to apologize in advance. We won't go through all of it. What I'm trying to show here is the structure of how we think about this, which is really the structure of how human beings are wired to think about things with a cause and effect relationship. Those of us who've had training in economics and finance have been taught that volatility equals risk. I don't think that's helpful at all. Volatility is just one metric, and it just means how much does the price move around, or how much variation is there in the return. Even if something returns really well, that's considered high risk. I think that's counterintuitive. It doesn't make a lot of sense. And when clients sign up, when clients think they're signing off on risk, often they think they're signing off on how tolerant are they about losing money. But statistically, what's really being measured is how tolerant are they about just having a lot of variation from quarter to quarter. I think risk, the way most people think of it, is the probability of having something bad happen. And so what we've tried to do here is create a risk metric which shows you different pathways to different kinds of risk. There's not one kind of crash. There's different kinds of crashes. There are crashes that are bank crises, and there are real estate crises, and there are leadership crises, and there are foreign currency crises. And the other thing is, even those who understand that you want to avoid crashes in smart beta funds tend to take a whole bunch of risk factors and just make risk factor soup out of them. Just put them all together in a list of 10 or 20 things and say, if you are flagged on any one of these, then you're riskier. And if you're not flagged, then you're not risky. When really it might be that only when you're over on this side with a lot of bank expansion does it matter if you've got these issues. But if you're over on this side, if you're over in the possible foreign currency crisis, these factors might not matter to you at all. So these things are logically related. If this, and this, and this, and this, then you're at a risk for this. But this doesn't matter for this risk. This doesn't matter for either of these risks. And that may seem strange because you don't see this a lot. But this is how you actually think about things. Someone comes to you a problem and you ask a question. Well, is it this or this? Oh, it's spiritual problem or financial problem? Oh, financial. Okay. Well, is it debt or whatever? This is how you counsel people in the real world. This is how you think about your own life. This doesn't tend to be how even the more sophisticated financial analysis goes on. And when they do this in a form called machine learning, where the robots are completely in charge and there's no principles and there's no logic. Whereas that's not what we're doing here. We're melding those two together. So let's just take you down a couple of these paths to getting used to thinking about this. So are you under financialized? Basically, this is an important metric. This is all told, everything about your country put together. do you tend to be in a situation where the global marketplace assigns a lot of value to your publicly traded instruments, whether stocks or bonds, relative to your economic output? Or are you a country, if you're a country that all you're doing is bartering cheese for fruit in a marketplace, you're not financialized at all. But if you're like the financial center of the world, then you're very good. You know how to do it. You've got rule of law. You're trusted. It's in your muscle memory. You've got good character habits that are recognized by the world. So they're willing to buy little pieces of your economy through publicly traded instruments with a high degree of confidence. If you're under-financialized, that's a risk factor. So if you're under-financialized, maybe it's stocks or bonds. Let's look at bonds. The world just doesn't trust your bonds. Well, have you done a recent bank lending spike? Have banks recently gone out a limb a lot in terms of lending? Yeah, well, yes. Well, have they gone out on a limb in terms of borrowing? They have to borrow in order to do all that spending? Yes. Are they concentrated in a certain sector? Are they maybe mostly in fracking or energy or something like that, and therefore vulnerable to oil going down? If yes, then you might be a bank crisis candidate. So let's go back to the root here. We're going to go through, this is going to be very similar to the next ones. Let's just kind of roll through them. We don't trust your bonds. Okay. You've done the banks have done a lot of lending. They haven't done a lot of borrowing, but they've put almost all of their lending into real estate. And then you get the kind of, and don't worry, we're diversified. We're in these really, really complicated hedging instruments called derivatives, which Warren Buffett called instruments of financial mass destruction. We don't really understand them. Somebody in the organization understands them, but they'll keep us safe so we can do unlimited real estate lending. Well, you have all that, and then along comes a storm, and you've got a real estate crisis. So let's just keep rolling from here. So you get the idea that there are multiple pathways, multiple logical if-then pathways to a crisis, and they all involve the violation of certain principles. Maybe you're not paying attention to intrinsic value and you're buying at bubble. Maybe government spending and borrowing and corruption has become a problem. That's a leadership crisis. Maybe you're not under-financialized, but maybe you're borrowing a lot across currencies, striking hands to be surety, borrowing in a currency that you don't have any control over, and you're not diversified, violating another biblical principle. Then you're more likely to have a currency crisis. Are we waiting? Is it stuck, or are we going to? And so these are multiple pathways. This doesn't have everything. There's a leg that we didn't put here, and we're always learning. And so what does that have to do? Why am I showing this to you now? Because we just had a crisis, so we can get some idea how this worked. So we've created here an interface where you can look and say, how many of these are flagged? Like if you're all red here, you're Russia. Russia's got a lot of red. Russia tends to be prone to catastrophic losses. If you're all red, they're in risk of a bubble model. But maybe you're only mostly red or mostly dead or whatever. Maybe you've got 4 bad factors, but you're okay on one of them for a bank crisis model. So not all of those nodes would be yeses, but some of them would be. So what we did is we took these and we rearranged them into a scatter chart, and we compared them to what happened during the crisis in the first quarter. So red means you've got a lot of flags. Green means you don't have a lot of flags, and dark green means you have no flags at all. You're not at risk for a catastrophic loss. And then along came the storm, and look who tended to get washed out. Upper left-hand corner, red. Upper left-hand corner, reds. It's not perfect. If this model were perfect, it would be all red here and all green here. But keep in mind, this is a crisis unlike any other. It's not your standard growth crisis. It's not your standard oil shock or whatever. This was a global pandemic. So the fact that this worked as well as it did in the midst of something like that, I think tells us a lot. So you tend to have green over there on the right where the returns are better. Everyone was negative, but there's the difference between being Denmark with an 8% negative return, all right, and being Pakistan which was flagged a lot with almost a negative 40%. You'll notice that all of those who are red, meaning lots of flags, are worse than 30% return, which is close to our cutoff for catastrophic loss. So let's keep going. You could also see this is a nonlinear relationship. It's don't get messed up by the math, just you fit to a curve. What that really means is almost all the actions over there on the left. When you're bad, it matters. When you're an A versus a B versus even a C, that doesn't seem to make a difference. But if you're a D or F, that really seems to make a difference. So this is asymmetrical. It's not additive across the whole spectrum. It is about protecting from downside catastrophic losses, or what we call around here cat losses, because because we're pet fans, I guess. But we don't lose our cat. We watch our cat very carefully. All right, so emerging markets. You saw that almost all the action was emerging markets. Most of the flags are for emerging markets. They tend to be the ones that produce cat losses. So let's talk about emerging markets. Do they overperform? Well, yes. When? Let's take a look. First, do they overperform? This is a correlation by time. So this is over time. So each one of these bars is a 6-month time period. And we're looking at the correlation between being developed and returns. So here, there is a strong positive correlation between being developed and your returns. Over here, there is a strong negative correlation between being developed and returns. So basically what that means is during these green periods, developed tends to overperform. During these red periods, emerging tends to overperform. You have a negative correlation between development and returns, meaning you have you get it, a positive correlation between being undeveloped and having good returns. And so what you see, if that was complicated, you can forget that. And what you can just say is green is when developed overperforms and red is when underdeveloped or emerging tends to overperform. Okay, what you see is most of the time is red. Most of the time, there's a correlation between being emerging and being a good performer. Most of the time, it pays to be an emerging if volatility is not your issue, if actual returns are your issue. It's a bumpy ride, emerging, but most of the time it's advantageous to be an emerging, but not all the time. So when are the different regimes? Again, this is almost like the storm thing. We have to add the time dimension. Okay, so here's what we've done. We've created something that shows when we have global sell-offs. So rethink your color code here. Green is when the world is performing positively, and red is when the world is performing negatively. The whole world. So this is average return for I think we have 44 countries in this universe. So we're averaging them all together. We're not distinguishing here between emerging and developed. This is the whole world. And what you can see here is that there are these times of whole world sell-off, sometimes very serious whole world sell-offs. So what we want to know is, what is the relationship between a whole world sell-off, this is the whole world, average total performance, and the differential between emerging and developed? And what we see is the pattern is after a whole world sell-off, EM tends to overperform. Let's look at the actual whole world crash, EM overperform, crash, EM overperform. Remember that crash, EM overperform, smallish crash, EM overperform. So whether it's the late 90s and the Asian contagion, whether it's the Enron crisis, whether it's the Great Recession, whether it's the global depression that no one noticed except the working classes in 2015, which kind of led to this wave of political populism. Over and over again, we see that when there is a global crash, not every single time, but generally when there's a global crash, EM crashes worse, but in the bounce back, EM overperforms. Let's take a look at another analysis of this. So this is, I was asking you to kind of visualize that with the last slide to kind of just get a sense visually of what it is. Here's running the actual numbers. So whether it's a 1-year period or a 6-month period, in the period of time following a global crash, 1 year, EM does 19%, DM does 9%. 10.5% differential. EM outperforms by 10.5% DM on average in the year following a global crash. All the other time periods where you don't have a global crash, it barely outperforms at all. The entire effect of this, all in, the added value from understanding this and using it as a strategy is a 10 1/3%. And this is also true of a 6-month period. It's even stronger in the 6-month. Because remember, this is an annual number and this is a half a year. So this is really 6 times 2, right? This is really almost 12%. So what we see, whether we're looking at it visually or whether we're looking at a grid, in general, it pays to be overweighted to EM as opposed to DM after a crash. Did we just have a crash? Yes. Did EM overperform coming out of that crash? Yes, the pattern so far has held. But it's not the only pattern. There's something else important going on, which is interest rates. If any of you have looked at my Blackboard videos, they're available at KA site. I recommend you go look at them again if you don't remember them. Some of the later ones, there's a whole lot about interest rates and the incredible importance and centrality of interest rates as a measure of who we are as a culture, and also the way in which we distort them in a way to avoid the consequences of our character problems, our overspending, our overborrowing. So manipulation of interest rates has an effect, and it has a global effect. We're so powerful. We're a hegemon. God in providence has given America tremendous economic and financial power, which means what our central bank does affects the whole world. And when we are hiking rates or expected to hike rates a lot, you get a global taper tantrum. And you get an EM actually being riskier tends to underperform slightly. But when you're not doing so much of that, when you have low rates or expectation of rates coming down or whatever, or even more stable actually works very well. EM is allowed to do its natural thing as higher growth economies, more attractively valued, and overperform. Well, what about that? We're in an after crash environment. What kind of interest rate environment are we in? Powell said, we're not thinking about raising rates. We're not even thinking about raising rates. Week before last, they had another meeting and he said, we're not thinking about raising rates. So that seems like that's a pretty good environment for EM given past history. Okay, Q2 was tough on those who panicked at the end of Q1. That's the double-minded man thing. You get caught up by the emotion. These are big sell-offs, duration of sell-off, duration of recovery. General pattern is the faster the sell-off, general pattern, the faster the recovery, but that's not universal. SARS is somewhat analogous to what we're going through, but frankly, we don't have anything else that we're like what we're going through before, which is why you can't let machine learning, you can't let the robots do all the work, because they can't think. God made us in his image. We can think. He can think. Computers can sort. So that's why our decision tree involves a lot of reasoning and principles, rather than just let the machine operate like AI and make connections, some of which don't make logical sense, or some of which causal connections. There might be something that isn't in the data set. There's nothing in anyone's data set like what we went through in the first quarter. So if you weren't reasoning through, if you were just reproducing models, then you weren't able to understand the dynamics of it. Okay, so what we saw here is that COVID was the fastest sell-off that we have in, probably history or available history for the United States stock market. We were a full bear market at -20 in 16 days. Global financial crisis took 188 days to occur, and it took a long time to bounce back from that. But we bounced back fast in the second quarter from our fast. Remember that red on the map. Really, there's maybe 2-3 weeks altogether where almost all of the negative performance was. So someone panicked and they got out. They missed a second quarter Dow Jones of 18%, an S&P, which is the best since 1987, an S&P of about almost 20%, best since 1998, a NASDAQ of 30%. U.S. did pretty well. Emerging markets did around that, depending on which ones you talk about, around that S&P and Dow Jones during the same time period, and outperformed developed markets in general. Okay, let's move on. Crash, we know that. Recovery, well, we're somewhere in that zone. What phase are we in now? IMF says this is a crisis like no other. They are forecasting a negative 5% for 2020. They were more pessimistic, and they're more pessimistic now than they were in April. And in January, they weren't pessimistic at all. So the great minds of our time, people can complain, that we should have acted. We knew as early as January what was going on in the world. Well, okay. Hindsight is 2020, but I would say that the IMF they're supposed to have their finger on the pulse of things, and they expected this year to be better than last year. So it's easy to attack people in hindsight. But they're also showing bigger growth next year than shrinkage this year. So think of it as there and back again. You go down into a hole, go down in the mines of Moria, you fight the Balrog, and you come back out, and you're basically where you started again. So this is essentially a round trip, a 2-year round trip back to where we started the year before the pandemic. That's their forecast. They said the recent rebound in financial market sentiment appears disconnected from shifts in underlying economic prospects. Well, maybe what they're saying is the markets disagree with our forecast, so they're wrong. Well, maybe you're wrong, IMF. Maybe the markets are right. I don't know. I'm not God. I know that markets tend to get the direction right, but tend to overestimate. So the truth could be somewhere in between. Let's take a look at sentiment. What we did here is we looked at Google search terms. What are people searching for on Google in the section dedicated? You can filter. I only want to know about economic finance. Of course, if someone's searching for economic depression, clearly it's an economics question. And we see when that peaked exactly when you would expect, exactly when markets were selling off, in late March, and then it declines, pops up a little at the end as there's a sense of, oh wait, so some state opened up and their infections went up. Maybe they'll have to shut down again. But it's still a lot lower than it was in March. So let's add another search term: economic recovery. When are people starting to think about economic recovery? Well, you see that's crossing here in April, just like markets did. Peaks here in May, but stays fairly elevated for this time period. So people had depression on the mind here, and they had recovery on the mind here. And they kind of recovery stayed more in mind than depression, relative. This is indexed. So let's add another search term: largest improvement. I think I mentioned to you 3 months ago that we were going to see a lot of numbers that would say this is the worst we've ever seen. And then we were going to see a lot of numbers that say these are the best that we've ever seen. You go down really hard, and from that really weak baseline, you come up with some of the largest improvements. And what we see is in May, we're starting to see some of the best improved ever around this economic recovery period. And in June, we're seeing a lot of largest increase in retail sales in 1 month ever, largest increase in such and such sentiment ever, largest increase in ISM. So again, don't take those to the bank. We are at the bottom of a hole, and we're coming out of the hole fast, but we're coming out of the hole fast in terms of our sentiment, in terms of the actual metrics. Let's take a look. Now, you remember last time, we've been talking about this for basically a year and a half: gross domestic product versus gross output. Hat tip to my friend Mark Skousen, the great economist who spent 20 years developing the theory behind this, and the Bureau of Economic Analysis several years ago said, "You're right, Dr. Skousen, we're going to start tracking it." And what you see here is that what almost everyone else is looking at, GDP, is really only half, a little more than half of the economy. A little less than half occurs before GDP is measured. But you've got friends who work here building things. They're not bought yet. Coal miners are here. Oil workers are here. They're producing something. Farming, a lot of things are going on here. You're invested in businesses. You have clients who are here. Not everyone's here, but almost all of the analysis, which calls GDP the economy, only looks at that half. Well, we're looking at the whole 40 trillion to get a better picture as to what's going on. So moving on, we take that 40 trillion roughly and we break it up into pie slices, and they're unequal because they should be. Some of these pie slices have a bigger economic impact than others. We've had a lot of media attention on arts, entertainment, recreation, accommodation, and food services. Restaurants are about this much, right? Everything except restaurants, all the concerts, all the everything, it's all here. Every time someone shows you an empty stadium or an empty theater on the 11 o'clock news, all of that comes down to about 1% of economic output. And retail is, something like 70% of GDP, but it sure isn't 70% of gross output. And remember, some of this retail is online and still going on, but empty stores are good footage. But let's just put them in perspective. Do you not care about stores? I care about stores. I care about restaurants. My grandparents owned a bar and grill. I was raised there. These are my peeps. But I also have to put it in economic perspective to be objective. So tragedy, but not macroeconomic heavy hitter. Construction, manufacturing, finance, and professional business services tend to be the heavy hitter. Construction, let's take a look at that. Not a super heavy hitter, but a big enough hitter. 77% increase in construction spending. Cranes and jackhammers are working again in many big cities. It has natural social distancing. It's outdoors. It's able to bounce back faster by its very nature. Finance, that's you and me. Professional and business services, I'm a little bit of that too. Financial activities. Department of Labor says 81% of people who work in finance can work from home. 81% of people who work in information can work from home. 70-some% of people who work in professional and business services can work from home. These are big ticket items in terms of gross output. Leisure and hospitality down the bottom, hardly anyone can work at home, leisure and hospitality, but it's not a big ticket item. It's a tragedy when a maid gets laid off. For her, because she might not have a lot of savings. But let's not let ourselves misunderstand the order of magnitude on total economic output and on the companies that you own in your portfolio, unless they happen to be leisure and hospitality. Manufacturing, big ticket items, 17%. Here we see, this is a great illustration of that principle of crashes a lot. This is change in output. Huge, biggest crash ever, right there. More crash, even after the biggest crash ever. How much can I take? Second biggest increase in 10 years. Third biggest increase in history. In the history of the data set. So the bigger the crash, usually the faster the recovery. All right, let's look at another manufacturing metric. This is a survey of manufacturers. What we see is we had most improved, largest increase in 40 years. But it's from the bottom of the crater at 43 up to a so-so 53. So again, it's the same pattern over and over again. Real good improvement numbers recently, but we haven't cleared the edge of that crater yet. So here, 3.1% increase in manufacturer's shipment in 1 month. I mean, multiply that by 12. If you annualize that, that's a great number. But it's still 20% below last year. But before this, it was 23% below last year. So it cratered and it's coming out fast. That's the pattern over and over again that we're going to see. And at this point, I think we're switching over to, yes, a different interactive computer program. Yeah, I know I talked down GDP, so we're just going to do it fast. Here's GDP. Why is that up there so high, Jerry? Why did you put that number, the GDP number, way up at the top? That's not good graphical design. He's not good at graphical design. Oh, we put it there so that we have room for the 33% crash. That was a terrifying number. So, or 38% according to this metric. That was a terrifying number that we just got. So, Jerry, why all the happy talk? It's not happy talk. It is tell the whole story. So let's tell the whole story. Let's zoom in on recent GDP. One of the problems I have with GDP is it tells the story of half of the economy. The other problem is that it gloms together, smushes together is the technical economic word, smushes together 3 months into one number: 2% growth, negative 5% growth, negative 38% growth. So it's all squished together. It doesn't tell us the individual monthly stories. Monthly data is called high frequency data. By the way, I don't think monthly is very high frequency, but it's a whole lot more high frequency than quarter. So what we can do is we can put high frequency data here, so we can it's like we're taking the microscope or the telescope and we're looking more carefully. We're breaking down, we're cutting the quarter down into smaller pieces. That's what analyze means. Analyze in Greek, it's a Greek word, means to cut something. And what we see is fascinating. Normal GDP, normal ISM non-manufacturing numbers. We go into the terrible first quarter, we're actually up a little bit. January was a happy month. Remember back in January? And February started out pretty happy. They probably were taking the survey results around here. If they'd taken them right there, I'm not sure they would have been so happy. And then what do we have? It's really the last month of the first quarter that we're really beginning to figure out that something's bad. And then the crash as perceived by managers, look at that. That's a terrible, terrible number. And that's just a terrible number. And then we're back to above normal. And now, after the quarter I'm talking about, we updated as of the past week. After that, sorry, I'm having trouble here with my paper. After that, we see really a rather solid 58 expansionary number. So really, the crash is here. It's very concentrated in a short space of time, and the high frequency metrics are showing expansion already. Now, the problem is GDP has to take all of this and put it in one number, when maybe this ought to be negative 90%, rather than just average negative 30%. Let's add manufacturing. Same story, almost exactly the same story. You see, you have to let the whole story be told. So do not let a negative 33 or a negative 38%, I don't know what that is. I think it has something to do with real versus nominal. Don't let a terrifying number just stand there. Slice it into pieces so that you can see that most of the terrifyingness was 4 months ago, not 1 month ago. That's an important distinction, maybe for you and for your clients. Okay, let's turn these. What are these ISMs actually signaling right now? This one is signaling a 3% growth rate, now and going forward. That's a little higher than I'd expect, but that's pretty optimistic. All right, that's the non-manufacturing. Manufacturing is also signaling about a 3%. What are markets saying? I like markets because they are the most high frequency metric of all. They're every minute. Well, you see, remember this metric. This is how much do you love bonds more than stocks? It's the Great Recession. I'm terrified. I love bonds a lot more than stocks. I want the sure thing, not the lottery ticket. This is the European crisis. Well, we were pretty terrified in March. So you see this spike this is a fear factor. And it's around here that I was talking to you and I said I thought the markets overreacted, and now they're getting less terrified. See, they're signaling something better. Their perception of risk is going down. Just like that other high frequency thing, there is a focal point temporally, sound like Star Trek, there's a focal point in time in March, early April for the fear, as signaled by markets and surveys. And let's move on to this, turn this into a model, and it's signaling between a 1 and a 1.5% growth rate. Let's take a look at, this is the spread, not between stocks and treasuries, but between investment and treasuries. It's the same thing. Spikes are fear. Falling from spikes is a falling of fear. You see the spike there, right? That's our March, April terrified spike, which goes with everything else in that high frequency. Our 33% negative second quarter is front loaded to the beginning and the end of the first quarter. And then we see a falling off in the risk assessment. And what is that implying in terms of returns? That's implying about a 2%. Which of these are right? I don't know which are right. Multitude of counselors, there is safety. Make sure to choose counselors who have a good track record. Make sure to know which of your counselors tend to be more emotional than others. All right, let's take a quick look at what markets are saying about inflation. They're not worried about inflation now. This break even predicts inflation now. Let me show you the next chart. High correlation between the break even rate. I should explain what the break even is. It's the spread between a regular treasury and a TIPS. TIPS compensate you for inflation when they pay back the principal at the end. Regular treasuries compensate you for inflation with a higher interest rate. So the spread between them is the expected inflation rate. It's not expecting much inflation. Should it be? Well, it shouldn't be expecting much inflation now because deflationary recessions are deflationary recessions. But look at M1. We are fighting the possibility of deflation with an enormous amount of money creation off the scale, which history, paying attention to history, would indicate future inflation, future significant amounts of inflation. And this metric, which is the one risk metric I like the most, gold prices, is basically saying we are very concerned about the dollar and about future inflation. We understand it's deflationary now or disinflationary now. Everyone understands that. But what we're doing to get through this crisis makes us much more worried about the next crisis. And with that, back to Rob. Thank you, Rob, for your patience.
Absolutely, Jerry. Great content. We covered a lot of ground today, and we do have a lot of questions. So I'm just going to get through as many of these as we can. Let's try to maybe do a rapid fire session here, Jerry, and move through these quickly. I'll start with Calvin. He says, what's the likelihood that after the stimulus money runs out, the economy will tank?
I don't think there's much likelihood of that because I don't think the stimulus money made much difference. So I don't think running out of the stimulus money will make a whole lot of difference either. I think we're a little too focused on the consumption of things rather than the production. We can keep the production going. People are going to continue to buy. We've got cash. So if we're reopening, you have the jobs, you have the paychecks flowing again. And employment is improving rapidly. Unemployment tends to be among people who don't have a lot of spending power to begin with. I don't want that to sound callous. They're not buying a lot because they don't make a lot. So average income's actually gone up. So I don't think we're that dependent on the stimulus for the economy. I think we are dependent on monetary stimulus, however, for the market valuations. So if we're talking about money printing stimulus, well, that's something else. But the Fed sure seems like it's going to keep the money machine going.
Very good. This next one comes from Ruby. She says, Jerry, we've discussed this in the past. Is the value style of investing dead? It seems like examining what a business is worth before investing is just not working right now. Is there hope for the future?
Hello to our neighbor from the north, Ruby. I think that value is definitely out of favor, and so many articles saying value is dead to me is a contrarian indication. I think that there's a misunderstanding about value investing, that value investing really, I think, to be done as well as it can be done should be done cognizant of the way that interest rates are distorting the economy. So if you just look at straight up value investing, what will happen is central bank hyperstimulation will make value problematic. It'll move everything towards growth. I'm thinking about doing a presentation on this to kind of show, using a discount model, what it is about that causes distortions. But you can't distort something forever. So I would say that I would not abandon a value discipline, but I would be aware that value discipline is undermined in the short and mid run by the Fed basically putting its thumb on the scale and practicing unjust weights and measures. And then everything isn't valued properly if that scale has a thumb on it.
Thank you. This next one from Tom Jerry. He writes, you mentioned the U.S. dollar as the world reserve currency for now. Why do you say for now? What do you think will be the new or replacement world currency? Could it be special drawing rights from the World Bank, or even a blend of currencies with a component of gold? What are your thoughts?
I say for now because it seems plausible within the investable horizon that we no longer have what Charles de Gaulle called our exorbitant privilege, which is being a reserve currency. We're really playing with fire on this. So if we take a sharp left turn in the election, that would hurt. Even if we take a sharp right turn in the election and we start talking about I'm the king of debt and we can default and we're going to renegotiate and the world owes us, well, there are so many ways that we can mess this up, this reserve currency status, which would be a highly inflationary event for us. What's the most likely replacement? I don't know. SDRs are run by a multilateral institution. I don't see a lot of hyper competence there. Maybe a blend of currencies. Here's a dark horse candidate: a blockchain cyber currency. If we really get there with wide acceptance, then we could end up doing. I'm not saying this will happen, but this is just running scenarios. We could end up doing something like that. Could end up doing to the Fed and the dollar what Uber did to the cab companies. Just creating a technological alternative, which means we don't have to use the cab company. We could just do it electronically, blockchain, without inflationary risks. Could be gold, could be a combination, could be regional reserve currency. China it would be one reserve currency, Euro would be another reserve currency, and we'd be, say, a Western Hemisphere or America's reserve currency.
Very good. Jerry, you mentioned digital currencies. I've gotten a couple of questions today about a few things that converge. One is this idea that several financial writers are talking about that indicates perhaps Bill Gates has a patent for a microchip that could be embedded and hold vaccination information, which is a concern because of COVID-19, but it could also contain financial information. And alongside that, this idea that we could see a bill in Congress perhaps proposing the beginning of an exchange of physical currency for digital currency, perhaps coming as early as next year. Any thoughts on any of those ideas that tend to accelerate as people begin to write about them and think about them?
I would say you have to be ever vigilant, but I would also say that my tribe, my evangelical tribe, tends to have maybe a little bit of a hair trigger when it comes to prophecy, microchip, 666, prophetic scenarios. So let's kind of self-police ourselves. Remember, you look at counselors and where they tend to be, error prone. We are a little error prone when it comes to false positives for this. So I'm not saying there's never any risk that someone's going to track all our data or everything, but I'd say that we also have to recognize our own tendency to see a lot of things that we are sure of that never happened. So this would require a deeper dive. I would say for those people who are concerned about sort of a global antichrist scenario and understand there are all sorts of Christians who have different prophetic scenarios, I would not see blockchain as an example of that. I would see blockchain as a countermeasure to that. It is peer-to-peer. So if that's a scenario you're really concerned about, it's worth looking into peer-to-peer blockchain that isn't issued by government as a hedge against that, not as the mark of the beast itself. This is not my area, especially. I don't write on eschatology. I'm interested in it, but it's such a muddle, and people have such strong opinions and there are people who know it a lot better than I do, that I tend to just be cautious about jumping to conclusions in this area based on my own experience.
Yeah. Thank you, Jerry, for your measured approach there and response. I appreciate that. This one from Calvin. How much will losing 50 million jobs hurt our economy moving forward? Have we felt the full brunt of that yet?
Is this another Calvin, or is this the same Calvin? We had a Calvin before. Was he predestined to ask a question twice? 50 million jobs matters, but if you get them back pretty quickly, it doesn't matter as much. So 50 million jobs lost for a short period of time is different than, the Great Depression, where you have chronic unemployment over a long period of time. Frankly, chronically high unemployment under the Obama administration, I don't mean to be politically, but there was slow growth, chronically high 7, 8, 9% over a period of several years is probably more damaging than 15, 20% unemployment for a fifth of a year or a quarter of a year. Another thing to keep in mind is, I don't want this to sound cruel, but generally the people laid off have been in professions that don't have high income for the most part. So their spending power wasn't that high. So what we have is a Christian compassion, maybe social justice issue more than we have a macroeconomic issue. Now, you might want to target like low price entertainment for people in the, in the sort of the middle lower class, are probably going to get hit more, than say luxury entertainment. So you got to pay attention to that. Also, there's some people, my brother-in-law works in a warehouse and he's putting in 90-hour weeks. So some people have upped their level of activity. So there are some people who've gone to 0 hours, but there are a fair number of people who've gone from 40 to 80. My hours are up, I can tell you, since this crisis. So just looking at unemployed versus employed as opposed to hours worked would give you, again, a more analyzed, a more cut up, a more nuanced view. So I'm worried about those people a lot because we love our neighbor. Macroeconomically, I'm not super worried about the unemployment effect on stopping us from having a pretty decent recovery.
Very good. Jerry, we're going to have to leave it there. I know you and your team put in an incredible amount of time preparing for this webcast. I know you use it for other things that you're involved in, but I also know you dedicate a lot of time just being ready to do this each quarter. So thank you for the preparation. Thank you for what you shared today. We covered a lot of ground, and I'll give you the last word here if you have any remaining comments.
My team and I thank you and consider it an honor and consider it a blessing to be able to work with you. And may God bless you and all the people listening and the people that they have an influence on, that there would be something from this presentation that would be redemptive in their lives and in their practices for the furtherance of the kingdom.
Very good. Well, Jerry, we're grateful for you. All the best. We'll look forward to being back with you real soon. May God bless you and your family. And folks, thanks for being with us today. This replay will be available next week in our experts library. And so if you'd like to check back, perhaps you missed a portion, you'd like to listen again, it will be there for you. Until next time, may God bless you. Bye-bye.